Welcome back. Last month, U.S. construction spending rose for the 11th month in a row. This month, Market Watch reports construction spending ticks up for the 12th month in a row. We're going to talk about three specific topics within construction spending. Number one, the strong and weak sectors, there's a growing divergence. Number two, taking advantage of the correlations. Some of the correlations, shockingly, are very strong. And number three, there are a number of sectors that are showing a lot of weakness despite strong construction spending, and it's a cause of some great concern. Month over month, we can see construction spending. Most sectors are flat to slightly in the positive. Highway and street up 4.1%, only in a month over month basis. That's nice. We're going to talk about highway and street. And also on a year over year basis, every single sector to the upside, in particular, again, highway and street, 26%, and manufacturing up 61%. Manufacturing looks great. What we're going to see in just a moment, this is actually a bad number. Now, total construction year-over-year basis correlates quite well with the S&P 500. It makes sense. Construction spending we can think of as a leading indicator. The money that's spent today in construction leads to profits and revenue tomorrow. Now, residential versus non-residential, and this is encouraging on one side. We've seen trouble in the housing markets. Hopefully this translates over, but the non-residential is certainly an area of concern, and we're going to actually break that down to some specific components such as commercial and office, and those really do not look good. Now, residential construction on a year-over-year basis, think of the home builder stocks. This is the third month in a row on a year-over-year basis. We're showing improvements. We're better off this time this year than this time last year. Non-residential, it's the opposite situation. It seems that whatever capital is going into residential looks like it's coming out of the non-residential area. Now, manufacturing, remember 61% year over year. That number looked great, that really big bar to the upside. Well, 61% is actually the lowest low we've seen in a long time. Manufacturing has really continued to slide lower, and it's not just construction spending. Remember, we spoke about this recently. Empire State Manufacturing, we hit the lowest lows we've seen since June of 2020. Well, it's the same sector. These are two different reports and very different angles of the sector, of the manufacturing sector, and they're both telling us the same story. Now, the reason why we mention these specific sectors is think of our own stock investments, our own holdings, potential investments. Think of the manufacturing companies. Maybe if we're a value player, we want to scoop these companies up cheap. That could be a situation, but it's certainly an area of concern right now. Now, an area that's not of concern, highway and street, up over the past year, 26%. In the past 3 months in particular, we've really seen a surge. Now, with that said, what can benefit from highway and street? Most of these companies are private. Well, think of the companies behind the sector, the companies we would use those products in highway and street construction projects, like, for example, Caterpillar. Now, just to be very clear, this is not at all a stock recommendation. We don't give stock recommendations, but what we do want to do is point out some very strong correlations, and we can see that since November, both highway and street construction spending and Caterpillar stock, for example, have been doing quite well. Other stocks also have been doing quite well. But this is the mindset that we should always try to have. We see the headline number, we look at the sector and then the subsector. Think of the companies that will benefit behind that. Now, with that mindset in mind, three very weak sectors also. Healthcare. Now, healthcare, we spoke about recently the Indeed jobs data report showed us around 7 of the 10 top hiring sectors are healthcare related. Maybe this doesn't translate over into hospital projects, but we're seeing some weakness in that area. Now, office year over year, office construction spending, it's up only 5%. This is the lowest low we've seen quite a while. It appears a lot of people are still working remote, and that's putting a strain on office construction. Lodging, Year-over-year basis, we've seen continued weakness as well, up only 5%. And then the bonus as well. Commercial, year-over-year, up only 1%. Now remember, we have a big divergence, a growing divergence actually, between residential and non-residential. Residential construction spending, maybe they see lower interest rates on the horizon. That certainly has been a big obstacle. Maybe there's a resurgence in construction spending in the residential side, anticipating lower interest rates. But the non-residential, and specifically think of non-residential, what is it? Office construction, commercial construction, shopping malls. They're not as directly tied to interest rates. The homeowner is a lot more sensitive to interest rates in a large construction shopping mall project. So they're experiencing their own weakness, and that weakness is not going away despite the approximation of lower interest rates. So please be aware of that and think of the companies behind the sector that actually benefit or could get hurt from this trend. Only 1% year over year. That's really not a good number. Now, we did a project recently. We took a look at some data, a lot of data, going back about 40 years, and we wanted to calculate how much stock could we buy with the average salary in the US. Well, in 1981, you could buy with the average salary 15.7 shares of the Dow Jones Industrial Average, wherever that index was at the time. Well, present day, you can only buy 1.7 shares. So it seems that the stock market has gone up a lot more than our salaries have. And we take a look at this data and a lot of other very interesting data in an article that we've put together. It's published on substack.com, our newsletter. Simply free to join. It's just the data. Make sure you put in the underscores between each words as well. And you'll see the real cost of inflation. We take a look at how much the price of a cup of coffee has gone up over the past 40 years. It's actually quite interesting. Which has been a better investment over the long term? Gold, the housing market, or the Dow Jones Industrial Average? Maybe you can guess. So we took a look at a lot of the data over the past 40 years, and we really try to use this information to construct the ideal investment strategy, the ideal financial plan, with these assumptions. And it's all absolutely free for you to join. The real cost of inflation. That's in our Substack newsletter. We hope this has been helpful. We look forward to seeing you back soon.